on, as you can probably guess here, options. And I'm going to be talking about the benefits and downsides of both calls and puts. I'm going to give a couple examples, and I'm going to go over some strategies that I use. So let's just start with the basics. And right now, the most important thing you need to understand with options is that the idea, at least from my perspective, is that you need to take advantage of the fat-tailed distributions that price dispersions are in reality subjected to. So that means that despite the standard distribution that's used to price the options, occasionally with some skewedness, you're likely going to have something like this blue line instead of the green line. Or sorry, you're likely going to have something like the green line, which is a fat-tailed distribution, greater probability of events that produce outsized gains and losses, such as an election, court ruling, a rise in oil prices, a major drop in demand, change in policy. And the thing that options also allow you to do is define the exact amount of capital that you're going to put at risk. So let's do an example with the estimated returns on some calls. So that's taking a long position on a stock called Birchcliff, which is right now trading at $2.32. And there's calls that allow you to buy the stock for $2.50 plus the cost of the contract, which is 15 cents. So at $2.60, you will start to earn a profit, and every cent after that, you gain at an increasing rate relative to the end of the contract. So let's take a look at what it looks like in real life. The Birchcliff contracts cost only $225 Canadian, and they go until April, which is generally speaking the end of the cycle for natural gas, and it allows for at least 2 or 3 solid months of profitability during these high natural gas prices. And let's just say that Birchcliff has a bad year and the share price ends around $4.25. Well, regardless of what contract you have, whether it's the February or the April, you're going to be looking at a $2,500 gain at just $4.25. And at even $3.75, which is less than $2 from the share price right now, you will be able to achieve $1,600 in profit. Now, this comes with the risk of losing your entire investment, the $225, in the event that the price does not reach $2.50, which is known as the strike price. And that's something that you determine when you purchase the option. You also determine when it expires. So whether you want to purchase a contract that expires in April or March, that will change the cost. So it could only cost $125, for example, if you were to buy a contract that expires in early March. But by purchasing a longer dated contract, it's going to be a little bit more expensive, but it allows for more time for the stock to enter the strike price and rise along with your profits. Now, Birchcliff has traditionally outperformed its competitors after a long and challenging recession, such as 2008. And because it's unleveraged, that means that unlike other Canadian oil companies, when the price of natural gas and oil rises, it tends to rise a lot faster and a lot more. And this speaks to the fat-tailed distributions because, well, the options may be priced for a share price movement between $6 to $7. Over a short period of time, it can very quickly go to $8, $9, which is an 81% gain from the $5 original share price. Now, that 81% gain on the stock would be a fantastic return. But if you were to buy an option at $2.37 and using the same contracts I purchased, you would be able to achieve upwards of $8,000 in profit. And that's not unreasonable, especially considering commodity prices are rising back up to where they were um, prior to the last 5 or so years. And if you take a look at the long-term chart, you can see that the volatility of this stock is actually an advantage because it allows for a lot higher returns, a $12 price to the lowest is a $5 price during periods of absolutely terrible commodity prices. And even with a very bad macro environment, meaning technology is where everyone wants to put their money. Oil's not looked upon favorably by ESG investors, and especially Canadian oil, which is trading at a massive discount to US oil. The outlook was very bleak despite Birchcliff retaining its share price throughout this time. And now that it's returning back to the conditions that allowed it to reach the $6, $7 share price, it's not unreasonable to expect at least a $4 to $5 share price before the strike price. Now, with a $225 investment, that results in well over a $2,000 return on that and a tenfold increase in the value of your investment. Now, this has been a lot of the reason for my success in the Canadian energy markets. I've been using out of the money calls to successfully leverage my capital in a way that allows me to have a predefined assets at risk, meaning I know that the maximum loss I can have is $2.25, as opposed to other methods like using leverage where you could potentially lose a lot more. And the share price at $6 would only give us a $356 return on investment versus the options contract giving a $5,000 return on investment. And this increases at an exponential rate, leading to higher returns for higher share prices because possibility of the stock reaching the share price is not priced in to the person that sells the option. And the person that sold the option likely assumed that the distribution would look something like this green line and that the share price would remain within a relatively narrow path. However, as we all know, events like the coronavirus, 2008, the dot-com bubble, and changes in commodity prices have resulted in far bigger changes than just $1 or $2 for share prices like Birchcliff. And to be able to purchase this opportunity to earn easily a 10 times return on investment, and in a worst case scenario, at least double the investment, that's not achievable with any other kind of investment instrument that is readily available to a retail investor. And